All right. Well, the reason why we're getting together to go over investments tonight is that we get very bad information from our financial planning industry when it comes to how we should be investing. And the reason why that is because we have to remember they are making commissions and fees from what they are telling you to do. So what we're going to do today, this is more of an educational thing. This is not like financial advice or anything, but what I want to do is show you with what I've learned over the 15 years when I was actually doing the fund management and stuff like that. I want to tell you the reasons why we sort of do things, but I don't want you to invest like the mutual funds and stuff like that, like people are telling you in the financial industry. I want you guys actually to invest the way we do as fund managers and institutional planning, because what you'll notice is when it comes to true investing, it's hard to say, and a lot of times people don't want to believe it, but the way institutions, they invest is totally different how you guys are told to invest. It's not the same information, and a lot of people will sit there and fight and say, oh no, they're looking out for our best interest. Well, what happens is I'm going to walk you through a couple of different things, and I'm going to tell you how I uncovered this going through, because when I started doing things, because in early 96, 97, I started just doing mutual funds, selling at the firm level, being, just being a planner, financial planner, and selling mutual funds. Well, what happens is a lot of the times, one of the first biggest problems that you have when you talk to someone that's just truly there to give you advice that's just going to make commissions for them, they're not really giving you the information that you need to be able to implement the plan that's in your best interest. It's in their best interest. So that's why what I want to do today is just talk about a couple of things that is to educate you on when you guys want to actually go and put money into a 401k or put money into a Roth IRA or put money into these places, that you do it where it's in your best advantage and not theirs. Okay, so one of the first things that you want to make sure when it comes to investing is you want to know how much you guys actually need to retire on. Because a lot of the times we think of inflated numbers of how much we really need to retire on because it's not done efficiently. When you do things efficiently, you don't need as much because you're not paying the tax man and you're not paying all the exorbitant fees that you have in fund management and stuff like that. So the first thing that you want to do whenever you talk to someone that is helping you put together your retirement plan, because that's what we're talking about today, is figure out the amount that you need to be able to live on. And you have to decide how much risk you want to take by saying, okay, what do I want to have that's replaced? If I could build a value that's able to pay my mortgage expenses or any expenses I would have like that, if I could pay the food, if I could pay the utility and transportation, just like when we talk about our four walls of expenses, you want to take a look at the food, utility, shelter, transportation, and your personal stuff that you need for healthcare. So if you have anything that is along the lines of prepays, any medical, medicines that you need to take, all that stuff, if that's paid for, and if you're comfortable with that, as long as that's paid for, well, then you don't really need to shoot for a portfolio value that you have to take more risk if you're happy with that amount. Now, let's say you want to have a little bit extra and you want to say, okay, well, I maybe might want to take some extra, I want to buy a boat vacation, or if I want to have a second home when I retire, or extra things, then you start throwing that in, knowing that, okay, if we need to take a little bit more risk, I could do that. And then that's where you start from. So the first place you need to start is actually build a plan and say, okay, this is how much money I need to put together to have this much retirement income. Here's the problem. Whenever you go talk to a mutual fund manager or a financial planner, what do they want to know? What's normally the question they ask you? How much can you invest?
How much can you afford?
How much can you afford monthly? How much can you put into this? What we're talking about is the accumulation phase. And a lot of times what's going to happen is when it comes to mutual funds, they're just going to want to know, hey, well, how much can you give me? Can I move? I could get a better return than your mutual fund guy over there. Why don't you just bring that money? They do not care about what you want done for your retirement. They just care about bringing a mutual fund over to make some fees. And to make a commission. So the first thing that you want to do is sit with someone that could help you say, okay, this is how much income I need, and decide, okay, I need this much income. And the first way that I would start implementing anything is I would take a look at my current income that I'm making now and just try and put aside 10% of your current income before you even see it. Try and set it up where it automatically, when you're getting paid, just take that 10% and put it into whatever you want to be using for your retirement planning. That is probably going to be the best thing you could ever do. And then what you do is you live on the other 80%, because of course we have 10% that's going as our tithe first, then we have that 10%. Then we live on the rest of the 80%. Yeah.
Do you recommend 10% each or 10% as a couple?
Now, depending on how you set that up, it all depends if it's in a 401k or a Roth IRA. But depending on where you set it up, if it's retirements that you're doing in tax advantage stuff, you do want to do it where your husband's going to have one and then the wife's going to have one. So you do 10% into each one in case there is some reasons. And we'll talk about how you want to make sure that you're investing in 401ks and Roth IRAs, but then also we're going to go through a reason why you wouldn't be using a 401k or a Roth IRA, and that's just because of fees and different ways that you could look at it. Okay?
So the investment here that we're talking about is separate than the $1,000 emergency fund and the savings of 4 to 6 months.
Yes, because what happens before we start investing, remember, the first thing is we have to have at least $1,000 or $2,000 in emergency fund. Then we need to pay off all our debts. There's no reason to be investing unless we have our debts paid off, because paying off our debts sooner than how long they're really going out. If it's going to take us 13 years to pay off our debts the way that the industry wants us to pay it off, well, if we pay it off in 4 or 5 years, what happens is we take all that money that would have went to the other people that we were paying interest to, and we put that in our pocket. So what will happen is when you're getting out of debt, you'll notice you will make more money by just paying off your debts first. By paying off those 18% credit cards, by paying off your car and paying off your house, you will notice that what happens is you actually make a better return on however long it takes you to get out of debt. And normally, looking through the other things that we do here is that you'll notice that when we take your income, because remember, we take your income first, and when we decide, okay, how much are we going to put to pay off the debts and our plan, that's in our cash flow plan. Well, what happens is you don't ever change how much money you're putting out of your cash flow plan to implement this. What you do is you just change the things around like we talked about to make sure that we are paying off our debts first. And then what happens is we don't take any more money out of our pocket. And on average, what you'll notice is that you could pay off all your debts, including your house, and then also including the cars and any other debts, usually in average in around 7 years. So I have people that do it a lot sooner than that. And then also there's people that might go a little bit longer. But what you want to try and do is make sure you pay off your debts first. There's no reason to be investing in something that could possibly be going up and down when you have 100% guaranteed return on paying off your debts, because when you pay that off sooner, you're making that return that every time you don't have to make an interest payment, you can You pay that first. So when it comes to investing, yeah, that's really the first thing you want to make sure is that you have your $2,000 that you have for emergencies, then pay off. Then what you want to do is make sure you pay off all your debts. Then after you pay off all your debts, then you start putting into that emergency fund for the 3 to 6 months is usually a good time. Once after you have that done, then that's when you want to start working on things that you could put the extra money towards mutual funds and stuff like that.
Index funds.
And mutual. Well, index funds. The reason why you said that is because one of the biggest things that is taught to people that they should be using mutual funds. And what happens is in industry as a whole, the institutions that sell those, the funds, the mutual funds, they are really the only ones that are making money on the mutual fund side. Because what happens is there are so many fees that you are paying as an investor to use a mutual fund. You're paying management fees, you're paying 12B1 fees, you're paying commissions. And as of 2012, they make it a law that they have to start disclosing all the fees that you're paying. But they make it, in your prospectus, they have it so opaque that you cannot really see what's happening. And one of the reasons why you would use a mutual fund instead of, use an index fund instead of a mutual fund is because mutual funds have roughly about a 3% extra charge. Now, when you think about it, is 3% all that much? When you talk to a mutual fund manager, you say, oh, no, don't worry, it's only 3%. You know, the industry standards, here's your expense ratio, and we're well within there. And what he's going to do is he's going to sell what the expense ratio is, but you won't see the true cost of all the fees that we're talking about that you don't physically see because they're not disclosing it as a 12B1 fee or something like that. But there's a list of other things that you as the investor in the mutual fund have to pay. You have to pay the trading costs. It's really not clear about where that is in your prospectus. It's in there, but you're not going to find it. They prey on the fact that you're not ever going to see how much that costs. Trading costs is another thing. The actual amount that it costs for them to be putting money in and out and changing these stocks in this fund, guess what? You're going to be paying trading costs. A lot of the time, those funds will sit there and go and have it where a 401k company, they will actually pay the fund more, the mutual fund company will actually pay them more money to be a portion of that 401k. Well, guess what? They're just going to push that across to the investor as, oh, that's just advertising funds. So even though you might see an expense ratio of like maybe 1.65 or something like that, on average, after you think about the taxes, because those guys are moving in and out, mutual funds are very tax inefficient. They're constantly buying stuff, selling it, buying it, and selling it. You're paying the fees for it because the institutions are making the great money on it. Go ahead and buy it and sell it. But then you have more taxes. So then you have to consider how much the taxes are in that. So what happens at the end of the day when you use a mutual fund, you're spending around 3% more, and it doesn't sound like a lot. Does 3%, if someone said, oh, well, if our fund is making this much and you're paying 3%, does 3% really sound like a lot? Does that sound like a lot to you guys? It doesn't. When you think about your retirement, and if it's going over 30 years, do you know how much that 3% is? Just give me a guess about how much you think. If you paid 3% more for everything that you're doing for the fund, how much?
$100,000.
Not 100,000. Nope. Keep going. Up. Yes. Over that 30-year period, guess how much money you've paid? Not 100,000. You might as well keep on going up.
$500,000.
Huh?
$500,000.
Pretty close to $500,000. If you think about 3 to 4 percentage points paid over your time period to a fund manager over that 30 to 40 years, it is very close to $300,000 to $400,000 that you paid out in fees that, guess what? You can't live on.
So tell us about the index funds.
Okay, now what happens is the reason why you want to use an index fund, number one, is because index funds, Jack Bogle is the one who put that together, and Jack Bogle is Vanguard. So if you want to implement any type of investments, anything that you want to invest, just go to an index fund like Jack Bogle. Guess what? You don't have to pay a commission to go there. So you're not going to have to pay a salesperson a commission to go there. But now what happens is you might want to talk to someone that helps you be able to come up with a good asset allocation, because we'll talk about that in a second. And we want to know how we get the best performance out of our investments. Well, 90% of your performance is going to come from asset allocation. Not how you buy and how you sell, if you're timing it right, am I in the market, am I out of the market? We'll talk about asset allocation, and the reason why we'll go through that is because 90% of your performance is going to come from an asset allocation. And if you set up the proper asset allocation, you don't ever have to mess with it, except once a year. We'll talk about it. You just want to rebalance it, that if it gets out of whack, what you do is you go back, and we'll talk about how to balance it. But you go back and you get the asset allocation. Guess what? You do it after the year has gone through, because we said, why are we using that? Well, guess what? An index fund, what it does, it mimics the index that you want in your investments. So for anyone that doesn't understand what that means in your asset allocation that we'll talk about, once you figure out what your risk level is, they're going to tell you, okay, you need so much in equities. Now, equities, the index for equities is like an S&P 500 fund. So you could get an S&P 500 index, or you could get a Dow 30 index. There's lots of different indexes. But so what happens is when you have an asset allocation, instead of all these people that are telling you, use these mutual fund managers, and because we'll make sure that you're getting in and out of the market and time in the market to make sure you're right, you don't need to pay a fund manager for that. And I'll tell you in a second, but you don't need to pay a manager for that. But what happens is that is what they consider managed funds. So what happens is you pay a management fee. That's where a lot of the fees start calculating up. When you use the index, nobody has to manage it. All it does is mirror that index. So if we want to be in real estate, we have an index fund that mirrors real estate. If we want to be in gold, we have an index fund that mirrors that. So now you could use something like the Dimension Fund or Vanguard. I like Vanguard. Any of these funds, what's good about it is that you could go and implement it and it costs you nothing. Because one of the things you do not want to do is pay someone a commission to implement this plan for you. Now, you could talk to someone that's like a registered investment advisor to help you figure out where you would want to, what your allocation should be. But a registered investment advisor charges you purely for his advice to set that up. He doesn't charge you a commission on whatever it is that's brought over. He just charges you for his investment advice. Now, when I was a registered investment advisor, what I used to do for my clients is I used to get paid 1% of the assets that I managed for them. But it never mattered to them about what I was advising them, because my fees were still the same. I did not do anything any different, but I would always get what was in their best interest, because a commission never meant anything to me. I just went out and found the best thing for my client. So when you do this, I'm going to walk through, for educational purposes, what we're going to talk about tonight. We'll talk about some asset allocations, because I think that's a good thing to talk about. But now this isn't investment advice. This is just what we want to talk about so that you guys could ask questions about, well, how would I do it, or how I want to change it. But before we leave tonight, we'll talk about an asset allocation that if you know pretty much what you want your asset allocation, you could just go to Vanguard, open it up, put that asset allocation in there, and you don't have to pay anything. So you're saving yourself a lot more money that way. So when we talk about the asset allocation, the one would be, asset allocations would be like S&P 500. So that would be if someone says, hey, you want to be in the stock market. Okay, then you hear, what are some of the other things that people say? Oh, you want to be in bonds for safety, right? Well, bonds, there's a bond index. That just helps for the bond side. When you want to do things that's even safer, we'll talk about this, because as we talk about an asset allocation, I'll tell you where you want to use it and why you want to use it. But what will happen is I will actually walk you through that. But you want to know the main reason why you want to use an index fund?
You take money in and out of it.
Nope, it's purely simple. I used to hear when I was in the industry in the late 90s and the early 2000s, I used to hear that 85% of the fund managers couldn't beat the index. The management fees that you're paying for can't beat the index. So you're sitting there paying this extra 3% for a managed fund that is what they call actively managed. You are paying that extra 3%, and 85% of those fund managers can't even beat the index. So why are we paying a fund manager that can't beat the index? Just go buy the index. Now, as of now, I'm thinking about like 2016. So I'm thinking 2016, and I'm here, the numbers that they have now is that because what's been going on recently, 90% of them can't beat the index. So when you think about it, if you could talk to someone that could help you decide what you want your asset allocation to be, you don't need to pay someone the commissions, because you pay a lot more in commissions and stuff like that. If you could get someone, or if you could read or educate yourself like something like this and be able to figure out what you feel is comfortable for you, why would you go pay a commission to someone that isn't even going to beat what I could go buy for free? Because you go in there, now there'll be the normal expense fees, but you're not going to have that extra 3% to pay for the actively managed, that they don't beat the market anyways. That's why we want to use the index funds. So even when you read things and you see things that you read that you might like, when you think about, okay, well, how should I do it? If you see something that says mutual funds, just figure out how it's invested and just use the index instead of the mutual funds. You could still use all the educational stuff that's out there, just don't use the funds. Because the only people that are making money when you have funds is us on the institutional level. That's the only people that are making money. Because we're making money on the trading fees, we're making money on all the other things, all the other fees. I used to get paid, well, I still get paid a percentage of what I made for my clients. So right now, the last time I managed a fund was 2008. Now, since I'm recording this, I have my new risk disclosure that's coming out, that's 2016. Well, my 2008 numbers, I can't really talk about that because it's outside of the 5-year scope that I put in my risk disclosure. But the funny thing is, the asset allocation that we'll talk about, deciding if that's something you want to use, in 2008, does anyone know how much the market lost? Now, we're just talking about 2008. We're not even worried about 2001 that lost just as much or even more before. But 2008 was really bad too. Do you guys remember opening up any 401ks around 2008 and opening up your things? The market on a whole lost 37%. So what happens is, what you have to look at, what you want to educate yourself to do, is you have to decide how much risk you want to take to decide what you want to have in your asset allocation. Because your performance is going to know, okay, how much do I want to put in the market? And what you want to be real careful of is, don't fool yourself. If you're someone that does not want to take a lot of risk, don't put money into an S&P 500 that everyone wants to sell you. You want to take a little bit of risk? Go ahead and put money in there, but don't fool yourself, because a lot of the times people always want to pitch, oh, look at how much we made. We made 18%. We did this. And they're trying to get you to invest there because of how much they made in the past. But it doesn't matter. The way you get good performance on your portfolio is to minimize your risk. If you cannot watch a $100,000 portfolio lose $37,000, or a $1 million portfolio that I saw a lot lose $370,000 of your income that you need, don't put all of your money into an S&P 500. And the reason why, so step number one was figure out how much you need to retire on, okay? So you want to talk to someone and say, hey, how much money do I need to have this much income? So what did we talk about for the income? I know I want food, utilities, shelter, transportation, and my medical taken care of. Now, if my portfolio over the next time period that I have before I decide to start taking income out of it, if that could accumulate an amount that I could take a fixed amount off of, and it gives me my income, do I need to take any more risk than I need to? If you could do that with nothing but secure things like U.S. Treasuries and stuff like that, why would you take any more risk? You don't need to take risks in the stock market. So then what happens is, as you need more money, then you start adding risk. So now the first thing that you look at when you want to assess your risk is, when I dealt with people, the people that I dealt with normally had, in my division that I worked with, these are people that normally had anywhere from $30 to $80 million. And one thing that I will tell you that is funny about them is that they don't care how much they could make. They did not make as much money as they made by not, they don't care how much they could make. What do you think they're worried about? How much can I lose? Any good business person that goes into any adventure, most of these people were like Sam Waltons or stuff that they had large amounts of money because of what they did successfully. They didn't go into their business ventures thinking, hey, how much can I make? No. They go in, how much can I lose? And let's go from there. So the first thing that you got to think about when you start thinking about putting together your asset allocation is, how much are you really going to allow this fund to go down without jumping off? And a lot of the times people say, oh, do you want to be moderate? Or don't let someone tell you what they think you are. There is, if you go to a free place to go, if you go to Stronghold Financial, they have a place at Stronghold Financial that there's no fee or anything for it, but they'll actually tell you, they'll ask you some questions to figure out what your risk is, and they'll help you figure out what your risk is. But what you want to do is just think about it. Hey, I have $100,000 I'm going to invest, and it doesn't matter how much it is. I'm just saying that because then I could use round numbers, and I'm not real smart, okay? So if you sit there and you look at it, and you have $100,000 to invest, if you're willing, say, hey, how much am I willing to let this go down that I will not get out of this fund no matter what happens? So if your $100,000 could go down to, let's say, $60,000, and you wouldn't pull your money out, then you could sit there and be in an S&P 500 fund that, you could have a risk that very easily you could lose 40 to 50%. So your $100,000 could very easily be $50,000. The reason why you want to be real about what your risk is because you do not want to get out of this fund when it's down. One of the biggest things that I see people do, and even Peter Lynch used to say it, investors do two things perfectly. They get out of the market when they should get in, and they get in the market when they should get out. Does anyone know who Peter Lynch is? Okay. Peter Lynch was the one who ran Fidelity's Magellan Fund. Now, Fidelity's Magellan Fund, from 1977 to, I believe, like 1990, the fund averaged 29%. Think about that. Over that time period, this guy was an absolute genius. If you think someone, because like I told you, most people, there are very few that actually beat the market indexes. But when you think about him, this guy was a mastermind. From 1977 to 1990, he averaged 29% a year for his clients. Would that not be a great return? Mm-hmm. Don't you think? I mean, you would sit there and be living on, I mean, there'd be quite a bit of income to live on. Here's the problem. Do you know how much the average investor made on his fund that made 29% a year over that time period? What do you think the average investor made? Just give me an idea. This is just talk about, like, just to figure out where you are, huh? 10%. They made about 10%. How about you guys? What do you think on an average? How much do you think they made? Okay, so they made 3%. Okay. Out of 29%, 3% is actually pretty close. What do you think they made? Okay. Now, when you're watching this on video, I want you to back this up and write this down. The average investor in the Fidelity Magellan Fund that made 29% a year lost money. And it's because of the rule number one we just talked about, was risk. Because what people naturally did is they did not think about their risk, what their risk was. And what would happen is, during this whole entire time frame, it was going down and up, down and up. Well, we had some roller coasters of down years, up years, and down years. And what naturally would happen, you would have your $100,000. You would tell yourself, oh yeah, I can make 29%. Yeah, no problem. Because what was happening, these people were going in here like crazy. Oh, they're making 29%. Well, they would go in, they would have a good year, and then all of a sudden, usually what happens, the next year, it would be down. Well, what happens is, if they got down to the point where their $100,000 was only worth $60,000, what do you think they're saying? They're hitting the exit door. It's a roller coaster ride. Okay? The reason why they were getting such poor returns is because what would happen is, once it went down and it lost the $40,000, what do you think they did? They couldn't take the risk anymore, and they got out. Then what happened? Then, just like the market, it goes back up. No, because over that time period, any 30, 40-year period, you will notice that, you're going to have about 9 losing years. If you take a look at a 30 to 40-year period, you're normally going to have about 9 losing periods. You could almost count on that. But what happens is, you have got to be able to take those waves that comes in and out and not get out when it's down, because what happens is, it's down, you get out, then it's up, you say, all right, everything's going good again, you get in, and then what happens? It goes down again, and then you're like, oh, so this has to be money that, realistically, you're not worried about touching for at least 5 or 10 years. Let that ebb and flow of the market work its way out. And what happens is, the way you guys, I got to be careful of the words I use here, but the way that you guys are brought to get into the mutual fund and suckered into actually doing it is because you see an average return of what the portfolio manager is telling you that they made. But you got to remember something. They take the average of that time period, and then they tell you what it is to average, but that's because some might be down 40% some years, it might be up 15 another year, it might be down 10, then it's up 80 another year. So as an average of that time period, you would make 29%. But if you get out when it's down because you're taking too much risk, you are not going to make the returns. But if you have it set up in your asset allocation, that you leave it alone. And if it goes down 40% and you say, you know, I have that much risk, we'll talk about asset allocation, but I'm not worried about it if it goes back down. Guess what? If you would have left it alone during that time period, you would not have gotten 29% because of all the fees and whatever, but you would have been positive and you would have had a very nice nest egg, probably at least getting at least 18 to 20 something percent on it. But that's what we have to be careful of. So when you're thinking about investing, make sure you do your asset allocation properly, because you have got to stay in anything that you're doing for retirement. If you are not going to be touching it for 10, 15, and 20 years, you should not be worried about getting in and out. You should leave it alone for that 15, 20 years, depending on how much, some people here might only have, they might only have 10 or 10, 15 years. You want to leave it alone for that whole entire time, because when you look at stocks as a whole, nothing makes more money than stocks in the long run. Because as equities and as a capitalistic society, markets always work their way out, and over long periods of time, you will always make the most money in stocks. But you're not going to make the most money if you're getting out once it gets low and you can't take the risk and you get back in. And then you get back in as it's doing better, because I used to talk to my mom about that. And it was crazy. Even my mom, when I first started and when I was actually doing mutual funds, I was trying to help her, and she wouldn't listen to me because I had the whole, remember how they talk about the powdered butt syndrome? After I powdered your butt, I don't have anything to listen to from you. But what happened was I was always telling her the same thing. You have got to think opposite of what your heart's telling you to do when it comes to investing. And I'm going to show you a couple of things that you could be doing that will help you get better returns, that has nothing to do with the fund manager you picked or whatever. It has everything to do with asset allocation. It has everything to do with rebalancing your portfolio. It's being tax efficient. That's how you get good returns. But I even used to tell my own mom, get in now. She goes, no, I'll wait until it gets a little better. And then it'll go up some more. Then, well, go ahead, it's getting better. No, I'll wait until she would get back in. When it's right back where everyone was happy again, everyone's back to where they were, you get in, and then within another couple of years, down it goes. So, even my own mom was held victim to this. So when I talk to investors, you guys are at a major disadvantage when you are talking to people in the investment field. They are taught to be pitching let's just say a story that you guys should understand. Because think about it. What is the story you always learn? Invest in your 401ks and invest in your IRAs and stuff like that. Put it in there and never take it out. Just forget about it. Why do you think they always told you that? Because the institutions make the most money if you put it in there and leave it alone. So one of the ways that you have to just sort of set it and forget it. You know how they always say, just leave it in there and set it and forget it. You got to remember, that's what you were conditioned to do from what the industries as a whole were telling you to do. Okay, so what we want to do there is make sure that we're looking at your investment returns. So number one is just take 10% of whatever's coming in and get it into there. You want to make sure it's going in there. But then, so after we figure out that it's 10%, we started talking about, okay, what's the difference between buying the mutual fund and buying the index fund? So let's think about this. Now we could use what's going on when people are talking about mutual funds, but why don't we want to use mutual funds?
Because you're paying the man that can't never beat the index.
Yep. You're paying someone more money that they can't beat the index anyways. So when you think about what you want to invest in, the one major takeaway that I would take from this is just buy the index. You don't need to invest with a fund manager. Buy the index of what you want to invest in. What you do is you go to you go to a place that sells index. Now you have dimension funds. Online? Yes, you can go online. You could also go to Vanguard. Vanguard was ran by Jack Bogle. He's the one that actually put the index funds together. And all you have to do is if you go to Vanguard, you will see that they have all the indexes that you would want to use. And then if you want to be in the market, you would use an S&P 500 fund or something like that. And we'll talk about some of the other asset classes that you would want to use. But the one takeaway that we want to take away from here is that if you want to have a percentage in your asset allocation, whatever that is that you want to put it in, just buy an index fund. Don't buy a mutual fund, because you are going to make more money in the long run just because you cut that 3% extra that mutual fund manager was, that you were paying that mutual fund manager to get subpar performance. They can't even beat the index. Okay, so that's where you are. So that's the first thing I want you to really remember, is only buy index funds. The second thing is what you're talking about. Only use people that are registered investment advisors. What a registered investment advisor does, if you are someone that needs help, what they will do is sit with you and help you decide what you need to put into your investments. But they do it as they charge you a fee to do that. So what happens is it doesn't matter. They will go out and find the best thing for you. And you know they're not doing it for a commission, because registered investment advisors cannot receive commissions on any product that they suggest to you. They cannot receive any commissions on anything that is put into your plan. The only thing that they could be paid a fee for, that you know up front, is the actual investment advice that they're giving you. That is the best way to do it. So you have someone that's on your side of the table, because a registered investment advisor is only going to make more money and is going to be successful if you make money. Because guess what? If you don't make money and your portfolio goes down, what happens to the registered investment advisor? He makes less money. Or I saw this too. You give him the boot, say bye-bye. Okay? So that's why you would want to use a registered investment advisor. Now, what's good about registered investment advisors is if you go to strongholdfinancial.com, what happens is Stronghold Financial is a registered investment advisor. Actually, by Barron's, they were ranked the #1 investment advisor. But what's good about Stronghold, you could go there. They have so much free stuff that you could learn about what you want to do, and you can implement it, and you don't get charged anything at all. But if you get to the point where you do want to have a registered investment advisor look at what you're doing, what you do is you just ask them to, either you could talk to them on the phone, they could tell you a registered investment advisor that's in your area that would help you put together that also. So that's really good. Anytime you want to check out what's going on the investment side, just talk to a registered investment advisor. So, and that you could do is go to strongholdfinancial.com. That's the best place to go, because then you know someone's not pitching you something for commissions.
I have a quick question also. When you want to start investing, what is a good round figure that you should be starting?
Now, what you start with, what we talked about, one of the first steps is any income that you're bringing in now, the first thing that I would do, you should always be investing for the rest of your life, because you are always going to be needing savings that you are living on down the road until you get to the point where you have a portfolio that you can say, I don't need to put any more money into it. You could, at that stage of the game, we're not talking about accumulation, because what we're talking about is investing, and just think of it as a mountain. What we're doing right now is we're going up the mountain to figure out how much money we need to go down the mountain, and figure out how much we need to be able to spend out all the way until the time that we die. I mean, it's a very ugly way of looking at it, but you're going up the mountain to figure out what you want. On the other side, you're not thinking about investing on the opposite side of the mountain. You're thinking about, okay, I take what I have, let me get an investment from this. And what happens is brokers and mutual fund managers, stuff like that, on a whole, will talk to you about getting you up the mountain. But then they just throw you off the other side. They don't care about that. But now think about this. Can anyone think why someone that would help you all this time, getting up to the point that you want to do, and you get up to the top and you received and you got all the money you need to live on, why do you think they don't want to help you on the distribution
They're not
phase.
making any money off you anymore.
Bingo. What will happen, and we'll cover it in other areas, is once you get to the point where you want to start taking money out of your investments to start living on, the last person that's ever going to call you about how to take income out of their fund is your broker and your mutual fund. You got to remember something. They're making investment fees and everything from the returns that they're making, all those exorbitant fees that we're charging you and stuff like that. We're making money while your money's there. Do we want you to take money out of there? So you are never going to talk to a stockbroker or a mutual fund manager or anyone that's making money on you leaving your money there. They're never going to talk about the distribution phase. And a lot of the times what happens, you end up falling and tripping and killing yourself down that opposite side. One of the worst places retirees, now we're not talking about it tonight, but one of the worst places retirees mess up their financial planning is on the distribution phase. Because everyone's left short. There's not very many people that want to help you on that side. And what happens is that everyone just wants to make money on helping you accumulate, but they can care less what happens. You could stumble and fall down the opposite side. So that's something that you got to be careful of. So that's a good question.
Going down the backside, you pass before you spend all of it. Where does it go? Is it willed to somebody?
If on the opposite side in distribution, yeah, what you're planning on the opposite side, just real quickly, what you do is you make sure that you have an income, a lifetime income for the rest of your life that you cannot ever outlive. And what happens is a lot of times when I was talking to clients on the opposite side, it costs a lot less money for you to get income. But then what happens is they say, well, what happens if I die early? Who cares? You're dead. I mean, it doesn't matter. But then you have to start thinking about, okay, what happens if I want to start leaving money to my heirs, leaving money to charities? Then what happens on that financial distribution side? Then you start using different things that says, okay, if I take so much income, if I don't get that income and I die prematurely, like you're saying, that income is passed to the beneficiary. If I have a charity or if I have a trust that I do, if I have an alma mater or something like that, that's where it goes to. So distribution, we'll cover that also, but distribution is a little different than the accumulation phase. Okay, so now let's talk a little bit about the asset allocation. Now, the reason why we want to do this is because when you get together an asset allocation, that is what's going to be giving you 90% of your returns. But what's taught as an asset allocation as a whole right now is very flawed. And the reason why, let's just think about, when people say, one of the big things they say, oh, okay, let's have 50% in the stock market, and then do 50% in bonds. And all we're thinking about right now is just very simply saying, okay, whatever we want to risk, we put in S&P 500. Whatever we don't want to risk, we put in bonds. Okay, now is that understandable? Do we need to clear that up at all? Okay, well, so now S&P 500 is anything you want to risk. So in 50%, we're going to consider, let's think about it this way. Let's even step back one more step. What we do is we think about 50%. It's going to be what we consider 50% at risk and 50% that should be secure. Okay? Now, what happens if we step back a little bit? What do we consider secure? What I'll do is I'll give a list so that you'll have it on video, that you'll be able to have it. But when we're talking about secure assets, the first thing that you want to think about is cash, because cash is it's pretty too, but it's pretty secure. So that's something that you don't really have to worry much about. Then cash equivalents, something like money market funds. So you're going to have that as a cash equivalent. Then you have CDs. Now CDs is a safe area, but that's something that you know that you're not going to lose very much money, but we have to remember in other areas, you're not going to make much money. But can you use a CD? Yeah, you could have that as some of the protection. Then, other than CDs, in that portion, these might be a little higher than what normal people would use, but what I'm going to do is I'm going to list it so that it's here that some people would do, but it might not be something that's understandable. But other things that the institutions use are first deeds of trust. Okay, what a first deed of trust is something else that you get a guaranteed return, that you know that if you buy a trust deed on something in real estate or something, you are guaranteed that you won't lose any money and you get a percentage return. So that's considered a first deed of trust. So if you want to look into something like that. Then also, since I opened up that can of worms, if you're going to do CDs, you have CDs that are linked to the market. So you would also want to think about CDs that are linked to the market as another thing for safe investments. And then the last thing that is in safe investments is annuities. Okay, so that's something else that you could do with safe money. And annuities is anything that you put money in that's guaranteed. And the way that I like to pretty much explain that is think about the annuity, because you're going to have people that will say bad things about annuities. And annuities are good when you use them properly, but when you go into an industry that is very commission hungry and profit hungry, they start putting out products that are really in your worst interest. But the annuity is not a bad thing. What it is think about Social Security. Social Security is pretty much an annuity. You pay into that, and what does Social Security tell you guys? You get this much. Well, guess what? You put this much in, this is how much you're going to get. There's no risk to it unless we're talking about the U.S. government. That is only as secure in that sense. But when you purchase it as yourself, what an annuity is something that's secured by the backing of an insurance company. And that portion, if you put money in there, it is backed by the insurance company that is the largest institutions in the world. The annuity is actually, I don't know how far we want to go down this rabbit hole, but the annuity was actually started with Caesar. So over 2,000 years ago, what the people that were fighting in war, what they would do is put money into, I forget what the word is, but the way that this has been going on for 2,000 years is that they would put up money, and if anything happened to them, they would pay their families. Well, what happens over thousands of years, it still happens to this day, that what you do is you give an insurance company money, and they guarantee you a set return. You could have annuities that you give them money, and right now you could get a 3% guaranteed return. So when things are bad in the stock market and whatever, this might be a place that you want to put some more money. You could put it in there because you're still getting a 3% return. And then what happens is, what will normally happen is then when the stock market starts doing better, people aren't going to want to put a lot of money in there, and then they go back in to the security side. So the safe side is your cash equivalents, CDs that are linked to the market, and then you have annuities. I'm trying to think if I forgot anything. The first deeds of trust is also there, because first deeds of trust are very secure also, because what happens is first deeds of trust, now that's more of an accredited investor type of things. Oh, I forgot to say structured notes could be in there too, but what would happen is accredited investors, when you have a lot of money, what they would do is banks would actually give you these structured notes telling you, okay, if you loan us money for 4 years, we'll give you this much interest, but it's very safe, and it's actually backed by certain things that it's safe. Now, the first deeds of trust, banks like also using that also, and registered investment advisors use them, just so that we know how that we use them. What a first deed of trust is, to be very safe with some money. One of the things you could do is, a lot of people that use first deeds of trust are real estate companies that are building. that they need some income and they need some income influx, so that they could finish projects and stuff like that. Well, what happens is they will go and they will say, okay, they'll come to the client and say, okay, I have a building, it's worth $1 million. What I would like you to do is give me a $400,000 loan with first deed of trust for $400,000. Now, what happens is that is a very secure investment for the person, because what happens is if that real estate developer or whatever doesn't pay you the money, what happens?
You get the deed.
You get the deed, and the deed says you own the property. Now let's think about this. The real estate meltdown that we had, even when you think the worst places that ever got hit, I mean, in something that was really crazy, we lost anywhere from 30%, 40 to 50%. Let's just say 50%. So now you gave up $400,000. Even if we had another massive thing that happened like that, so that's where the risk would be. If that is $1 million, what you do is you get issued, just like when you buy a house, you know how you get that appraisal report? You would actually have an appraisal report that says, as standing, you could sell it for $1 million. Well, if you sit there and you want to go back out in the market, there is someone out there that will definitely buy $1 million $1 million building. And you want to know something? Sometimes we can say, okay, I'll sell it to you for $500,000, and now you just made another $100,000. So it's secured by the first deed of trust. So that is something that is very secure. That one of the things that you might want to have in your riskier portion of the investments is real estate. Well, these are some of the things that you're balancing how much you're risking. You could actually be safer by how much you're bringing in by income from the first deeds of trust. Okay, so that is when we think about the 50-50, the secure side is what we just went through, is all that. Okay, so that's anything that's secured, but then also the things that we didn't put in there is U.S. Treasuries and U.S. bonds, and then also tips, which is government tips, which is what they are. They're treasury investments that you would use, like if we have inflationary things, they pay higher things. But now I don't want to get too much into that, but that's like pretty much what we have. So we have all of that. Now that's considered on the safe side. Do we have any other questions?
Where's the IRAs and 401ks?
That now, IRAs and 401ks, that is a wrapper that holds our investment. That's what we have to remember. When we have our investments could be held however we want. We could have our investments held at a bank account. I'd want to get your head examined, but it could be held at a bank account. Banks, don't invest with banks. Horrible place to invest. But you could hold that account that you're holding money. You could hold it at a bank. Then you could hold it at a mutual fund company, right? So you could hold monies there. You could also hold it at a brokerage account. You know, you could have an AG Edwards. You could have American Express. You could have any type of brokers. Merrill Lynch's. We have Merrill Lynch around here, Edward Jones, so you could hold your money there. Then you can, that's pretty much the places where you want to hold it. So now that's the first place that you could hold money. Now what you do when you talk about a 401k or an IRA, all that's doing is taking your investments wherever it's held, because you could hold it in money markets, you could hold it in anywhere that we just talked about on the safe side. And then also on the aggressive side or the risk side, you can hold it anywhere in these things, anywhere you want, okay? But what happens is then you take the wrapper of an IRA and you put it around it, and what that does is keep the taxes off of it. Do the same thing with a 401k, and that keeps the taxes off of it, okay? So now Those wrappers, remind me to talk a little bit about the wrappers because we might want to look at those fees also sometime. So let's think about 401ks, and when we come back to it, let's talk about 401ks and Roths and IRAs, about how we're holding our investments, because right now we're just actually talking about the physical investment. Okay? All right, so we have the physical investment. And now before anyone needs aspirin, I think we might need to change this into 3 nights. So did you have any other questions? Okay, so now we have that where we could hold that. So now on the other side, for the riskier side, now it's not that they're risky, but it's just something that if it's not something that's a little more secure, but it goes up and down in value, that's the other side. So that side is what you consider like the stock market or the S&P 500. That's what does the S&P 500. The index fund would be the S&P 500. For stocks, then they have REITs for real estate. So you would want to invest in a REIT index if you wanted to do something in REITs. Then you also have different capitalization. So you have small cap funds, large cap funds. I don't want to get too worried about this because when we think about educationally wise, what you want to be, the type of asset allocation that you could use, I mean, you don't have to worry about a lot of this stuff, but I'm just going through the different things. But you have all the different capitalizations. You have international funds, which means that there's just, and then also when you go to if you go to Dave Ramsey's, the site, he explains the asset allocation portion very good. He explains what does it mean to be in a domestic mutual fund? What does it mean to be in an international? I would go and watch that and then figure out what he's saying or listen to it online. You can find that type of information out there that he really breaks it down to tell you exactly what each asset class it is. And he does a great job of breaking down what each one is. So that's in there. And then you have small cap funds. Then you have an aggressive fund. You have income funds. That's all up there. So now what happens is right now you have 50% in the aggressive side for your asset allocation, and you have 50% in the secure side. Okay, so we're all on the same thing there. So now what happens when we have 50% on the secure side and 50% on the risky side? People tell us in the industry we're balanced, right? That's where you got to be careful, because if you have a 50-50 fund, because of the risk, we are told, oh, we're balanced. And they're always talking about their balanced fund. The funny thing is, if their portfolios were so balanced, why in 2008 did they average losing 25 to 40%? They're balanced, right? All these people that are telling, oh, use us because we're balanced. We'll balance things out. Pay us more money and all the fees because we'll help you balance it out. How did they lose all that money? Well, they were going up and down, but there was no balance at all. Even if you have 50% in the S&P and 50% in bonds, what they want you to think and what you've been taught is that there's a negative, it's a negative correlation, that if the stock market's going up, then bond prices should be going down or stay about the same. But then what do they tell you? We protect your portfolio in the equities on the bonds because as the stock market comes down, the bonds will protect you and not let it go down as much. Has anyone heard that story before? That's what they try and teach you, is that, okay, protect yourself with the bonds. But now think about this. If we think about the S&P 500, and we were talking about the time period that we were talking about from the same 30-year period, what will happen is the S&P 500 lost money 9 times. Those 9 times accumulated for 145% loss over those 9 times in your 30-year period. So if you think about it, the funny thing is I see some people frown and stuff like that, but when you think about that same 30-year period, there's not been very many 10-year periods until the recent 10-year period that they consider the losing decade. You know how they consider it the lost decade? Do you realize that is the first decade that you ever look at that if you put money in on the long term, you would have actually lost money. This was the first period from like the 2000s to 2030, whatever the lost decade was. That was the first time that you would have actually lost money. All the other time periods going back, you would have made money over that 10-year period. But now, if we're losing 145%, and then that same time period, the bonds only lost 6%, how negatively corresponding is that, what they're trying to tell you? It's not, because you've lost three times more money on 50% of your money. You've lost 3 times more than the other portion. That is not, when you take a look at your portfolio as a whole, the S&P over that time period lost 95%. So if half of your thing lost 95% of your portfolio value, that is not balanced at all. But that's what they're teaching you. Oh, do this 50-50 and you'll be balanced. But you're not even close to being balanced. So let's talk about an asset allocation that would be a little more balanced. The first thing that I would do is, when you think about an asset allocation, when you think about stocks, a good asset allocation would be, now I'm talking about this as for educational purposes. The portfolio that I'm looking at is a fund manager called Ray Dalio. Now, Ray Dalio, his portfolio, he only invests for major institutions and for governments and stuff like that. He has not accepted money in probably over 10, 15 years going back now. He hasn't accepted any investor money. But that is the fund manager that I will, when we're talking about educational things, we'll go from this guy, because you could not have him manage your money unless you had $100 million investment. So your minimum investment was $100 million. And you had to have $5 billion, would it be, in assets. Okay, so this is a guy, when we want to model something or think about how we're going to educate ourselves of how we want to do something, this is a guy that we could listen to. So this is not me. This is not something I did. When I looked and when I learned about it, I followed someone that he manages $160 billion. He manages funds for U.S. Fed Reserves. He manages funds for the largest institutions out there. So this is the guy that if I want to put money into the market and be protected, I want to know how this guy's doing it. Well, what happens is he likes to put 30% into the S&P 500, so that's the stock side, okay? So he puts that there. So now when we think about this, if you do nothing but just take index funds and put it in this, and you go to a Vanguard, this way you don't have to worry about understanding things too much. But if you just take this right here, and we're going to go over a couple more things, if you just take this right here and implement it at Vanguard for no cost, you don't even have to worry about talking to someone to have investment advice or whatever. I'm telling you what one of the best financial minds does for his clients. So you have 30% in a S&P 500 index fund. Then he puts 15% in a short-term treasury type of fund. Now, the short-term treasuries is going to be something that's around 7 to 10 years. So you want to put 15% there, an index that does that. Then you want to have an index that does 40% goes into long-term bonds, government bonds. And that would be something 25 years or so. So as long as you find an index fund that has maturities of the government bonds to be 25 years or more, that's where you could put that index. You could put 40% of the money in there. Then he puts 7.5% in commodities. And commodities is pretty much the portion that that you put in, because it has, in inflationary times, when we have bad problems with inflation, they tend to still be able to make a good return if we have inflation come into our portfolio. And then the other 7.5% is in gold. All right, so how much does that come up to?
100,
Does it come up to 100%?
I'm guessing.
Did anyone write them down? I see someone calculating, huh? So we have 7.5% in gold. We have 7.5% in commodities.
50.
Then we have 40 in your long-term bonds. You have, which is 25 years or more. Then you have 15% in short-term, which is your 7 to 10 years. And then you have 30% in S&P 500, which is, there it is. Now, what happens? That is your asset allocation. Now, here's what we want to do. Remember how we said we could do this and we can invest in index funds in this portfolio asset allocation. And then we don't have to worry about, do I need to pick this? Do I need to pick that? Or whatever. And the reason why we like to use this just for educational purposes is because in 2008, he lost 3.93%. Now, what does everyone want to know? If in the last 30 years, his portfolio lost 4 times, and most of the times it wasn't even 1%. One of his largest loss was in 2008 when we had a total meltdown, and it was 3.93%. So people want to know, hey, how do I limit my risk? If I had a portfolio that everyone else was losing as much as they did in 2008 and I lost 3.9%, I'd be skipping to the loo. That's what we're doing with the asset allocation. So that's not what I'm telling you, but that's what I'm telling you the investment mind has done. Now, what you want to do, anytime you're doing that portfolio, you also want to take a look, hey, how to do over the last 30 and 40 years. Over the last 30 and 40 years, he averaged just shy of 10%. So if you actually put your money in there and just forget about it, and you're not being talked into people saying, oh, get out. You're not worried about, oh, it's down, won't let me get out. Okay, it's up. Okay, let me put it back. You don't want to try and time the market. If you try and time the market, you will be in trouble. If you take an asset allocation, now this asset allocation, you don't have to mess with it. Because what happens is, over that same 40-year period, he made just shy of 10%. It didn't matter with all the ups and downs. He made 10%. Well, just shy. I forget what the exact number is, but it was just a hair shy of 10%. So when we want to invest, when I tell my wife, if anything happens to me, take my assets and put it in to that. Now, I'm not telling you guys to do that, but that is something that I would use as a benchmark to sort of educate yourself and figure out, okay, what am I comfortable with? But Heather knows if anything ever happens to me, you take our assets and put it into that, and then I know no one in the financial industry is going to try and talk her out of anything that I have set up for my family. Because once you put it in that, you don't have to do anything. So she doesn't need to pay fees or commissions or anything like that. Now, here's the other thing I would say to do. Once you put it into that allocation, use Vanguard or use Dimension funds or something like that, that has no fees. Well, they'll have the actual Vanguard funds itself will have fees for the actual index fund, but they don't have other fees like the management fees and all that stuff, just like any other index fund. I would tell her to go to Vanguard and do that asset allocation with their index funds. End of story. You don't have to worry about, do I invest now? Do I get in? Do I get out? Then, what you do to make sure that you're getting the best bang for your buck is annually, every single year, after the year has passed, I would go back and rebalance the portfolio. Regardless of what happens. If stocks did really well and did incredible, I want you to force yourself to sell out of something that is doing fantastic and doing great at the time and put it into something that's not doing as well. Good investors will always do that. That's the difference in between a smart investor and the investor, the normal average investor that will sit there and take the ride of the wave all the way up. Then what happens? Then they're sitting there surfing on the other edge of the wave too, and it's coming down, it's crashing on them, they don't want to get out. So what you do to take the emotion totally out of it is annually go ahead and rebalance it. So if whatever that asset allocation is, you go back, take a look at everything as a whole, and you get it back to where it falls into that allocation again, and you redistribute everything to be that way again. This way, you are actually getting out at the highs, what we need to be doing, and putting it into something that's at lows. So what this does, it takes your common nature of wanting to do something, of getting out when you should be getting in, and getting in when you should be getting out. It takes that and throws it out the window, and you do it as a set it and forget it. You know, every single year, you could sit there and rebalance your allocation. As long as you do that, what will happen is in the index funds, they are also more tax efficient. So if you do that, the tax efficiency of the portfolio actually gets you almost 1% more. So you're actually even making more money because instead of using a mutual fund that's buying and selling, you're getting all those taxes and everything, even though you're not getting it if you're in a 401k or whatever. You might not be paying those fees, but guess what? When you take a look at it, there is not investment return for you there because it had to be paid from the fund level. It did not get put in there because every time you buy and sell, you're getting traders' fees and all that stuff. So as long as you rebalance, as long as you put that asset allocation into index funds, you rebalance annually, that's all I would leave on a note for my wife with the pop. Because what I do is I actually have it set up where I already have the application and everything filled out. All she knows. See, that's how I take care of my family. I know if anything ever happens to me, I have a drawer that Heather knows to go to. She sees that there. She knows she could send that application in, and she knows exactly how I want their money to be invested when I'm not around. So that's why I do that. I do that because I try and protect my family. And one of the biggest person you need to protect your beneficiaries from is the financial industry. I promise you. They will figure out a way to get more of your money in their pocket than your beneficiaries. Okay? So now that right there, we do want to talk a little bit about 401ks and stuff like that. But that's your actual investment. Now, I wouldn't tell you to go invest in that. That's what I personally want to do, but depending on what you guys want to do, I would look around and see how you want to implement what you want to do. If you want to be 100% in secure stuff, be 100% in secure stuff. If you want to be a little more aggressive, you could go and do research on stuff that's a little more aggressive, and you could implement it the same exact way with the same index funds and just do the same exact thing. Okay, so that would be the good way to do it. Now, here's what we got to be careful of. 401ks charge you even another percent. Because what happens is you're paying more on 401ks. So what happens to sort of round this all out? With your investments, if you have a 401k that you want to invest in, but they only have mutual funds, you got to be careful because what happens is now you're paying mutual fund fees and you're paying the 401k fees, which means that down the line, you are losing a lot of return. So in your 401k funds, the things that when you look at different things, the things you want to avoid are mutual funds And then you also want to avoid target date funds. These are the retirement funds that say, okay, you're going to retire at 2033. What happens is they're doing the asset allocation for you, and they do things. What they notice as an industry, it's just very ineffective, number one. But number two, there's a lot of fees to that too. So as long as you avoid the target date funds, is what they pretty much call them, is the TDFs, the target date funds. Like anything that says, okay, retirement 2030 or retirement 2050, just forget. If it's in there, don't even use it. I mean, you want to stay away from that. But in the 401k, if you do not have it, where you are able to invest in index funds, what I would do is go to that same place. If you go to Stronghold Financial, and then I believe they're associated with Best 401k, what I'll do is I'll make sure, now that this came up as a question, I will make sure that I put that up, and I'll put it on the site, and I will get you the information. But if you have a 401k, what you do is you go to the Best 401k in America.com. I think that's what it is. I will get you that site. You go there, you put in all your information, and for free, they will tell you what the fees are in that. And if you find that the fees are too high, I would stop putting money. I would not use the 401k. I would go ahead and implement something outside of the 401k, because it doesn't matter even if you're getting matches. And even if you're getting other stuff, what I would do is go to the Best 401k in America.com. And if you notice there's a lot of fees there, you would be better just going into a normal mutual fund, paying the taxes. But if you don't have it, I would open up a Roth IRA first. You know, you want to be using your Roth IRA. If you're self-employed, you know, you could use solo 401ks, but Roth. Anytime you have the ability to do anything Roth, meaning you pay the taxes going in, but everything that accumulates is tax-free, and when you take it out, it's tax-free. You want to use Roth.
AmericasBest401k.com.
Okay, AmericasBest401k.com. If you take, thank you, if you take your 401k and go there, guess how much they charge you to do this analysis for you? It's an exorbitant fee. It's free. That's what you as investors, because you will always manage your money a lot better than someone that is looking for a commission or whatever. If you just deal with Stronghold Financial, they do it free of charge. You can pretty much get any information you want. And if you do need to talk to a registered investment advisor, they even have one there. And then also you want to do, if you are worried about your 401k, all you have to do is bring your 401k to AmericasBest401k.com and put all that information in there, and they will tell you all the fees. And if you find that it is too much, just go to the HR department and say, please stop putting money into the 401k, and I'm going to go ahead and implement a IRA for yourself outside of doing the. Now, you do want to do the Roth IRA outside. You want to keep on doing that unless you're in debt. If you're in debt, remember your first investment is pay off the debts first. So if you're in debt, the thing before this was getting out of debt. When we talk about investments, we do not invest for retirement or anything. We don't do any of this stuff until our house is paid off, until our cars are paid off, until all our debts are paid off, because we could very much get a guaranteed return paying that stuff off first. But here's the problem. Once we get all that stuff paid off, we're 100% debt free. There is going to come a time that we need to start investing, because we're going to have all that income that we've been putting into that to pay off our debts. We're going to need to put that in somewhere. That's when you start taking that income and putting it into a Roth 401k or a Roth IRA. That's when you start investing, because there is nothing better than those four words. I mean, those four letters. That Roth, nothing beats it. If someone calls you and says, hey, Mom, I have the 401k. Should I do the Roth 401k or should I do the Roth? You don't know how many times people call me and say, hey, we have Roth 401ks or the regular 401ks. Which one should I do? Roth. anytime Senator Roth's name is connected to anything with the tax code, do that. That will be good advice. Just stick with the Roth. So pay down your debts, and once you do finally start investing in money for your retirements and stuff like that, go ahead and start with your Roths, your 401k Roth plans, and any type of wrapper you want to put around your investments. Because remember, by that time, you're putting almost 15 to 20% into your investments at that time. Remember how we talked about once you get out of debt, you're putting close to 15% towards your investments at that time. That is a great time to start putting into your Roth IRAs and your 401ks, as long as it's a good 401k. If it's a good 401k, then go ahead and put it in at the job, because that best 401k, well, America's Best 401k.com, they'll tell you if there's good fees and everything in there, that you want to do that. That's a good place to be. But if it's not, you could allocate that the same exact way. Use whatever mutual funds that are closest to the indexes that we were talking about. Do the same exact allocation, leave it there, and don't worry about it. Reallocate that yearly, and then start taking the money you're not putting into that 401k anymore, a good 15, 20% of your income at this point, since we're out of debt and everything. Go ahead and put that 20% into your Roth IRA or your 401k Roth, the way that we talked about investing it here. And if you just go ahead and set that up, then you don't have to worry about, should I be doing this? Should I be getting into the market? And should I be getting out of the market? How are we on time, huh?
Do you suggest using deferred comp?
Deferred comp, what's good about deferred comp, just so that you understand what deferred comp is. Deferred comp plans, what they do is they take a portion of your assets and they put it into your deferred comp plan, which means that you don't get taxed on that as your compensation for the year. So what that does is reduce your taxes. Now, if you do something that you set up yourself, you're going to do something that's a lot more efficient than a deferred comp plan, unless it's done properly. Now, you could go to the best 401k plan and put your same thing in there. And if you have a deferred comp plan that, gets a good bill of approval there, I would use the deferred comp plan also, because it is a good way to reduce taxes, because you are not paying taxes on that income. So I would go to the same website. There's no cost to do that. And then also what happens, that's a great site, because if for some reason you find that that these other places that it's not efficient or whatever, you could just start sending your $200-300 a month. You could set up online. You could set up an account with them that doesn't cost you any money at all, and just start sending your $300 a month to them, and you can set up exactly what you want online with them. The other one that I like also is TIAA Craft, which was, I forget his name, but he set that up for teachers. That was, it's a foundation that everything at TIAA Craft/public, all the information you get there, you can implement a lot of your other plans. If you have other questions, just sort of get in touch with me. Say, if you have questions about anything that's not clear here, when you go back and watch it, or if there's any questions here, go ahead and just email me or write a comment down below the video, and I'll answer you there, because everything that you'll notice, I'll always try and help you, guide you to a place that you could do it for free. And that's the way you really want to do stuff. Keep the fees out of there. I'll let you know a place that you can go to implement it for free, so you're not paying commissions and fees and stuff like that.